Most people assume that the UK tax system is a fixed, non-negotiable bill. You earn a living, HMRC takes its cut, and whatever is left over is yours to keep. But the tax code isn't actually a single set of rules. It's more like a menu. And if you only look at the front page, you are entirely missing the hidden options that the wealthy use to legally protect their income every single day. Every year, billions of pounds in legal tax reliefs go completely unclaimed in the UK. The problem is, HMRC isn't going to call you up to remind you to claim them. The burden of discovery is entirely on you. If you don't know the exact name of the relief or the specific box to tick on your self-assessment, the money simply stays with the Treasury. Today, we are pulling back the curtain. We're breaking down 6 of the most powerful, underutilised tax entitlements and structural allowances in the UK. And by the end of this video, you'll see exactly how one specific overlooked rule allows some individuals to pass on hundreds of thousands of pounds completely free of inheritance tax. Let's start with where you live. Most people know they can't be taxed on the profit when they sell their main home, but very few realise how much tax-free income that same home can generate while they live in it. This is where the rent a room relief comes in. If you rent out a furnished home in your main residence, the government allows you to earn up to £7,500 every single year, completely tax-free. It doesn't matter if you own the property or if you're renting it yourself, as long as your landlord allows you a lodger. If you share the income with a partner, the limit is split to £3,750 each. What makes this spot on is that it's a gross income limit. You don't have to calculate expenses, heating bills, or wear and tear. If the rent you collect is under £7,500, it is automatically exempt. You don't need to tell HMRC unless you're already filling out a tax return for another reason. But what if your side income doesn't come from a spare room? What if you're just sorting out a small side hustle on weekends? That brings us to the trading allowance. Every individual in the UK gets a flat £1,000 per year of tax-free trading income. If you sell old clothes online, do a bit of freelance consulting, or clean cars on your street, and the total revenue is under £1,000, you don't owe a penny. And you don't need to register as a sole trader. Moving from individual shields to household wealth, the UK tax system treats couples as 2 entirely separate entities. This structure often penalises households where one partner earns significantly more than the other. However, there are 2 distinct allowances designed to rebalance the scales. The first is the Marriage Allowance, and it is shockingly underclaimed. If one partner earns less than the standard personal allowance of £12,570, perhaps because they are looking after children or took a career break, and the other partner is a basic rate taxpayer, you can transfer 10% of that unused allowance across. That means transferring £1,260 of tax-free coding to the higher earning partner, cutting their tax bill by up to £252 a year. It might not sound like a fortune, but here's the trick. You can backdate your claim for up to 4 years. If you qualify and haven't claimed it, HMRC will send you a lump sum check for over £1,000. It takes roughly 10 minutes to set up online. But what happens when family responsibilities mean you need to step away from work entirely for a period without losing your job security? Many employees are entirely unaware of their statutory entitlement to unpaid parental leave. This isn't the standard maternity or paternity leave you take when a baby is born. This is a separate, hidden employment right. If you've been with your employer for more than a year, you're entitled to take up to 18 weeks of unpaid leave in total for each child up until their 18th birthday. You can take up to 4 weeks per year per child. Now, because it's unpaid, you might wonder where the benefit lies. Analytically, it is a powerful tool for 2 reasons. First, it allows parents to manage childcare gaps during long summer holidays without burning through their paid annual leave. Second, if you are sitting just inside the higher tax bracket, say earning £62,000, taking a few weeks of unpaid leave can strategically drop your net adjusted income back below the £60,000 threshold, a topic we've covered extensively in the video on screen above. This fully preserves your household's child benefit without triggering the tapered high-income child benefit charge. It's about trading short-term salary for long-term tax efficiency and lifestyle balance. When we look at building multi-generational wealth, capital gains tax, or CGT, becomes a major hurdle. If you give an asset, like shares in a family business or a piece of commercial property, to your children, HMRC treats that gift exactly like a sale. They calculate the market value, look at what you originally paid for it, and hit you with a CGT bill, even though no actual money changed hands. It forces many families to sell the very assets they want to preserve just to pay the tax. But there is a way to hit pause on this. It's called Capital Gains Tax Gift Holdover Relief. Under Section 165 of the Tax Code, if you gift qualifying business assets or shares in an unlisted trading company, both you and the person receiving the gift can sign a joint election. This effectively tells HMRC, don't tax this transfer now, instead pass my original cost basis over to the recipient. Let's look at the maths. If you started a business for £10,000 and it's now worth £100,000, giving it to your child would normally trigger a capital gain of £90,000. With holdover relief, that tax bill drops to zero on the day of the transfer. Your child simply inherits the original £10,000 cost basis. The tax is deferred, not eliminated, but it allows the asset to keep generating revenue within the family uninterrupted. Perhaps the most mechanically complex yet brilliant allowance in the entire UK system is the starting rate for savings. Most people know about the standard personal savings allowance, which lets basic rate taxpayers earn £1,000 of interest tax-free. But if your total earned income is on the lower side, there is an extra hidden band worth up to £5,000. If your income from employment or pensions is less than £17,570, you can qualify for a 0% tax rate on up to £5,000 of savings interest. Here is exactly how the calculation works. Every pound of non-savings income you earn above your personal allowance reduces your £5,000 starting rate by £1. So, if you earn a small pension of £13,570, you are £1,000 over your personal allowance. That means your £5,000 starting band shrinks by £1,000, leaving you with £4,000 starting rate band. You can then make up to £4,000 in savings interest entirely tax-free within that band. Plus, you still get to stack your standard £1,000 personal savings allowance right on top of it. For retirees living off a mix of modest fixed income and accumulated savings, this single combination provides up to £18,570 of completely tax-free cash flow. This brings us to the ultimate exemption, the one that completely disrupts how people view inheritance tax. Most people are terrified of the 40% IHT threshold. They try to give their money away early, realizing they have to survive for 7 years for those gifts to fall out of their estate under the potentially exempt transfer rules. If they die within those 7 years, the estate gets hit with the tax. But there is an absolute exception to the 7-year rule. It is called normal expenditure out of income. If you make regular gifts out of your surplus income rather than capital accumulated savings, those gifts are 100% exempt from inheritance tax from the very second they leave your account. There is no 7-year wait, no tapering, no limit on the total amount. To make this stand out, HMRC, you must meet 3 strict criteria. The gifts must be part of a settled, regular pattern of giving. They must be made out of your regular income, like a pension, dividends, or salary. Crucially, the gifts cannot reduce your standard of living. You must have enough income left over to maintain your usual lifestyle. If an individual has substantial pension income that they simply don't spend, They can transfer tens of thousands of pounds a year directly to their children or grandchildren to pay for school fees, mortgages, or living costs. As long as you keep meticulous records, that wealth bypasses the 40% IHT net entirely. The true takeaway here isn't just that these individual rules exist, it's how they compound when you look at them as part of a unified strategy. When you start stacking a £7,500 room rental on top of a fully utilised trading allowance, transfer unused personal allowances between spouses, and protect family business assets with holdover relief, you aren't just saving a few quid here and there. You are fundamentally altering the velocity at which your household wealth can grow. The UK tax system is undeniably complex, but understanding these structural boundaries is exactly how you transition from just earning money to actually optimizing it. The system is designed with these rules for a reason, but it relies on you taking the initiative to claim them. Knowing these exemptions is only half the battle. To truly lock in your financial freedom, you need to know how to channel these tax savings into a highly tax-efficient wealth machine. If you want to see exactly how to combine these foundational allowances with a highly optimized investment strategy using ISAs and SIPs, click on the video showing on the screen right now. Let's break down the mechanics over there.